This is Chuck Carnevale. I'm the Chuck in the Markets Up Chuck. And today's blog was titled Averaging Down. And the real question there was, when do you know when to sell or buy more of a stock after it falls? And that's, a dilemma that I think investors face all the time. The general answer to that question that I think is so important is you make that decision one company at a time, because not all stock price falls are the same. For example, if you look at a name like Cognizant Technologies here, you have a company that's had excellent earnings right through the recession. You can see their stock price correlated very closely to their earnings, for the first, 8 or 9 years on this chart. Then we did get into the recession, and we had this huge drop in stock price. Well, the company has no debt on the balance sheet, generates very strong cash flows, and as an investor in here, it makes a lot of sense that you would be averaging it down, because nothing has really happened to change anything on the company. The company is doing extremely well, and yet the stock price has fallen. Now, in contrast, look at a company like Worthington Industries. It's had very erratic earnings, over its history. It's a steel company, and it's been very cyclical. And price drops are not necessarily good times to be buying down. You had a price drop here, and you might have got a little rally, but then years later you could have been, seeing your stock value still below what it was worth. Same with other periods here. The real point is you have to make your decision independently of the general markets or how you feel. Just because its stock failed doesn't mean it's a bad stock. It could be a great opportunity, or it could be a long-term risk. Now, I do want to make another distinction here with Bank of America. I want you to notice with this stock, it tracked earnings, very strongly, and it was generating good earnings. Of course, some of that was, back through the irrational, exuberant period and so on. But then we had this huge collapse in earnings, and the stock price fell. But now there was a strong rally in this stock, but I want to make a point. The fundamentals do not support this price movement at this stage. Now, someday they might, but the point is this now becomes a speculation, and I'm not in favor of speculating. What I'm saying is when the company's still healthy, that's a good time to buy down. I don't believe in buying stocks down where the earnings are collapsing underneath the company. So if I contrast, Bank of America to Aflac, I want you to notice earnings have been excellent. They've been excellent right through the recession. This company is actually raising their dividend, producing great operating results, have a very good balance sheet, generates good cash flows. And here was a case where the stock price fell. And had you bought it when it was, at its bottom, it got down to $11 a share. It's now currently trading at over $40 a share. This is the kind of company you want to buy down because the business is still sound. Everything is still good. It's not a company that, is in a lot of distress like Bank of America was. So, I'm not in favor of buying companies' stock just because the price fell. I'm only in favor of buying a company's stock because the price falls when it was unjustified by the operating results of the company. If the business is still good, as Marty Whitman said, you're making a difference between a permanent impairment of capital and a temporary interruption in the stock price. So the point is you do have to make these decisions one company at a time. This is Chuck Carnevale. I hope this gave you some additional insights. Look forward to talking to you again tomorrow.